In the heart of the financial world, a seemingly invincible titan crumbled into dust, leaving a trail of devastation in its wake. The Enron scandal wasn't just about numbers.
Enron is a company that deals with everyone with absolute integrity. We play by all of the rules. We stand by our word. We mean what we say what we mean.
It exposed a web of deceit, greed, and shattered trust. As the corporate giant fell from grace, the ramifications rippled through the lives of countless employees and investors. How did one company's ambition lead to one of the most notorious collapses in American history? Join us as we delve into the shocking details of the Enron scandal, the corporate catastrophe that changed the game, the rise of Enron. The story of Enron Corporation begins in Houston, Texas, where it emerged from a merger between Houston Natural Gas and InterNorth in 1985. This merger might have sounded like just another business deal at the time, but it laid the foundation for one of the biggest energy companies in the world, and later, one of the most infamous collapses in corporate history. Let's step back for a moment. Houston Natural Gas, HNG, itself had deep roots, dating back to the 1920s. Originally formed from Houston Oil Company, HNG grew steadily over the decades. By the mid-1970s, the company decided to shift focus, selling its retail gas business and concentrating on gas exploration and production. By 1984, it was a solid player in the industry, with assets totaling $3.7 billion and profits of $123 million. On the other side of this story is InterNorth, which started as Northern Natural Gas Company in Omaha, Nebraska, back in 1930. It had built a massive pipeline network and by 1984 had revenues of $7.5 billion. InterNorth was facing corporate raiders, a common threat in the 1980s business world, and its CEO, Sam Segnar, knew he needed to act fast to keep the company in control. That's when the idea of merging with HNG came into play. The deal was announced in May 1985, with InterNorth acquiring HNG for $2.4 billion. At first, it looked like InterNorth would be running the show. The new entity, HNG/InterNorth, would be based in Omaha, with Segnar as the chairman and CEO. But things changed quickly. By 1986, Kenneth Lay, HNG's former leader, was in charge, and the company had a new name, Enron, with its headquarters now based in Houston. Under Lay's leadership, Enron's transformation was nothing short of remarkable. The company boasted the second-largest pipeline network in the U.S., with over 36,000 miles of pipelines stretching across the continent and into Canada. But Enron wasn't just about moving gas through pipes. It had bigger ambitions. It became the largest marketer of natural gas and electricity in the country, managing an impressive portfolio of natural gas risk management contracts. In the late 1980s, things began to shift. The Federal Energy Regulatory Commission had started easing some restrictions on natural gas pricing, opening the door for local gas companies to buy gas from anywhere they wanted. This was a game changer. Ken Lay saw the opportunity and was quick to renegotiate some of Enron's expensive contracts from the 1970s, giving the company more flexibility to thrive in this new landscape. Then came one of the most innovative ideas in Enron's early history, the gas bank. Developed in 1989 by Jeff Skilling, a consultant from McKinsey & Company, this concept treated natural gas like a commodity. Instead of being solely a gas producer, Enron positioned itself as a middleman, facilitating the buying and selling of gas between suppliers and customers. It was an instant success. Soon after, Skilling joined Enron's trading division, and the company began its transformation into a financial powerhouse. By the 1990s, Enron wasn't just trading gas anymore. It was trading electricity, coal, steel, paper, and even broadband fiber optic capacity. Enron essentially redefined itself as a trader and market maker in these commodities, with financial transactions far outpacing the physical assets it held. For example, by 2000, Enron owned 5,000 fewer miles of pipeline than in 1985. But its gas trading operations represented more than 20 times its pipeline capacity. In 1994, Congress gave states the green light to deregulate gas and electric utilities, and Enron wasted no time in seizing the opportunity. California, with its newly opened market, became a major focus. Enron spent $100 million annually trying to make headway there. though by 1999, that particular venture was shelved. However, Enron didn't exit California entirely. It continued to supply wholesale power to the state. What's fascinating about Enron during this period is how it positioned itself as a leader, not just in energy, but in innovation. The company earned a spot on Fortune's Most Innovative list for several years, reaching an impressive number 7 on the Fortune 500 list in 2000. But as we know now, all that glitters isn't gold. The same innovative drive that propelled Enron to success would later contribute to its downfall, as aggressive financial maneuvers and shady accounting practices led to one of the biggest scandals in corporate history. But for a time, Enron was the future of energy, and the future looked bright. Leadership turmoil and financial deception. In February 2001, Enron made a big leadership change when Kenneth Lay stepped down as CEO, handing the reins to Jeffrey Skilling. But Skilling's time at the top was short-lived. He stepped down in August, barely 6 months later, and Lay returned to his old role. This back and forth in leadership was happening just as the company's troubles started to come into view. One of the first major red flags was Enron's broadband division. In the company's Q2 earnings report for 2001, Lay admitted that while the energy side of the business was doing well, the broadband division was struggling. How much struggling, you ask? A loss of $102 million to be exact. It was a sharp contrast to the rosy picture that had been painted about Enron's prospects in broadband technology. At the same time, Lay sold a significant chunk of his personal Enron stock, 93,000 shares, netting him about $2 million. All the while, he was telling employees via email to keep buying Enron stock, confidently predicting that prices would soar. Over time, it was revealed that Lay sold over 350,000 shares, raking in over $20 million. This was troubling given the storm Enron was about to face. Meanwhile, Sharon Watkins, an Enron vice president, had her doubts about the company's accounting practices. She wrote an anonymous letter to Lay, outlining her concerns, and later met with him in person, presenting a detailed 6-page report. The report was reviewed by an external law firm and Enron's own accounting firm, but both downplayed her warnings. On October 16, 2001, Enron dropped a bombshell that sent shockwaves through the financial markets. The company announced that it would need to restate its financial statements from 1997 to 2000 due to significant accounting violations. Now let's unpack what this really means. Imagine a company boasting about its profits and growth, only to reveal that its earnings were inflated by a whopping $613 million, 23% of the profits it had reported during those years. That's a hefty slice of pie missing from the corporate feast. To add to the drama, Enron also revealed that its liabilities at the end of 2000 were $628 million higher than previously stated, and they had to reduce their reported equity by a staggering $1.2 billion. It was like a financial game of Jenga, where one wrong move could topple the entire tower. And while the company's management tried to downplay these figures, claiming they were primarily due to investment losses, the air of skepticism was thick. Enron's then CEO, Kenneth Lay, put on a brave face, saying they wanted to clear the clouds around their core energy businesses, but not everyone was buying it. Just days later, Jeff Skilling, Enron's former president, had made the bold claim that the company's broadband unit alone was worth $35 billion. This statement was met with a raised eyebrow from analysts who were scratching their heads and wondering if they were missing something. One analyst from Standard & Poor's candidly admitted, "I don't think anyone knows what the broadband operation is worth." It felt like a surreal game of financial charades, with everyone guessing what was behind the curtain. As the days passed, the scandal deepened. Enron's CFO, Andrew Fastow, revealed to the board that he had pocketed a staggering $30 million from compensation deals tied to the LJM limited partnerships. This revelation sent Enron's share price plummeting to $20.65 in a single day, a $5.40 drop that left investors gasping. Just when it seemed things couldn't get worse, the SEC announced it was investigating Enron for its opaque and suspicious dealings. Lay tried to calm the waters, assuring everyone they would cooperate fully with the investigation, but trust was waning. By October 25th, it became clear that Fastow had to go. Lay, who had previously defended him, announced his removal as CFO, a move spurred by banks that were hesitant to lend money as long as Fasto was in charge. But with both Skilling and Fasto out, analysts wondered if this would truly fix the problems at Enron. The company's stock had now plummeted to $16.41, a 50% drop in just over a week. Jeff McMahon took over as CFO amidst a financial storm. His immediate challenge? A cash crisis.
As part of the new management team of Enron, my focus is on the future of the business, the future of our nearly 20,000 existing employees worldwide who are looking for continued employment with the company.
Enron had suddenly found itself unable to roll its commercial paper, effectively cutting off access to billions in financing. To reassure investors, McMahon and his team began buying back commercial paper worth about $3.3 billion, depleting the company's lines of credit in a desperate attempt to stabilize the situation. It soon became apparent that Fasto's focus on off-balance sheet maneuvers had led to a neglect of basic corporate finance principles. Enron was in dire straits, operating without proper tracking of cash and debt maturities, making it, in essence, illiquid. It was a stark reminder that no amount of creative accounting could mask the fundamentals. As October drew to a close, industry experts voiced concerns about potential manipulation of accounting rules. Yet analysts found it nearly impossible to assess the situation due to the incomplete information Enron provided. The specter of Enron's potential bankruptcy loomed large, echoing fears of long-term capital management's collapse just a few years earlier, which had threatened global financial stability, from junk status to infamy. On November 28, 2001, credit rating agencies took a crucial step by downgrading Enron's credit rating to junk status. This was more than just a financial blow. It was the nail in the coffin that sealed the company's fate. Investors and creditors knew that Enron was in deep trouble, and so did Dynegy, a fellow energy company that had been discussing a potential merger with Enron. Sensing disaster, Dynegy quickly backed out of any future merger talks on that very same day. Enron's stock, once soaring at over $90 per share, tumbled to just 61 cents by the end of the day. The company's collapse became inevitable, and it wasn't long before the first significant piece of the puzzle fell. On November 30th, Enron Europe filed for bankruptcy, signaling the start of a swift and brutal unraveling. 2 days later, on December 2nd, the rest of Enron followed suit, marking one of the largest corporate bankruptcies in U.S. history. But the scandal didn't stop there. In the aftermath, Enron severed ties with its auditor, Arthur Andersen, accusing the firm of advising employees to destroy documents that could serve as evidence. This led to a major accounting scandal that brought down Arthur Andersen, one of the world's most respected accounting firms at the time. In 2006, Enron sold off its last remaining business, Prisma Energy, as part of the liquidation process. By the following year, the company had rebranded itself as the Enron Creditors Recovery Corporation, with the sole mission of paying back what it owed to its creditors. Upon emerging from bankruptcy in 2004, Enron's new board of directors went after 11 major financial institutions, accusing them of helping hide the fraudulent practices of Enron's top executives. These banks, which included big names like the Royal Bank of Scotland, Deutsche Bank, and Citigroup, were all entangled in the scandal. The legal settlements that followed brought in a hefty sum. Enron managed to collect nearly $7.2 billion from these financial institutions. It was a small victory in the larger mess that was Enron's downfall. Kenneth Lay, the former CEO, pleaded not guilty to 11 criminal charges, which included securities and wire fraud. Even though Lay was convicted of 6 counts and was staring down a maximum prison sentence of 45 years, he never saw a day behind bars. Lay died unexpectedly on July 5, 2006, before he was sentenced, adding a final twist to his controversial story. Then there was Jeff Skilling, Enron's former president and COO, who faced 28 charges of securities fraud.
Do anything wrong that was not in the interest, and all the time that I worked for Enron Corporation, that was in the interest of the shareholders of the company.
He was convicted on 19 counts and sentenced to 24 years and 4 months in prison. However, in 2013, the U.S. Department of Justice struck a deal with Skilling, which reduced his sentence by a decade, cutting down his time behind bars considerably. Perhaps one of the most infamous names in the Enron saga was Andy Fasto, the company's former CFO. Fasto, along with his wife, Leah, pleaded guilty to a laundry list of charges: money laundering, insider trading, fraud, and conspiracy. Fasto was sentenced to 10 years in prison without parole, but in exchange he testified against other Enron executives. He has since been released from prison, serving his time and playing a significant role in helping prosecutors take down others involved in the scandal. The dark side of mark-to-market accounting. At the heart of Enron's deceptive practices was a controversial accounting method known as mark-to-market, or MTM accounting. So, what exactly is mark-to-market accounting? Essentially, it's a method that values assets and liabilities based on their current market price rather than their historical cost. Think of it like this. If you buy a painting for $1,000 and its market value skyrockets to $5,000, MTM accounting lets you list that painting at its new value on your balance sheet. This approach has been part of generally accepted accounting principles, or GAAP, in the US since the early 1990s. While it offers a more dynamic view of an organization's financial health, it can also lead to significant volatility, especially in markets where prices fluctuate wildly. Enron embraced MTM accounting with enthusiasm, which allowed them to project inflated profits by estimating future earnings based on optimistic forecasts. Unfortunately, this led to a massive disconnect between reported earnings and actual cash flows. The company could claim impressive profits on paper while the reality of its financial situation was far less rosy. As a result, when the actual cash flows from their assets turned out to be significantly lower than what they had touted, the discrepancies began to unravel. Let's not forget about the role of special purpose entities, SPEs, in this narrative. Enron set up these shell corporations to hide their mounting losses. Essentially, these SPEs would report losses using more traditional accounting methods, but since they were separate entities, it became nearly impossible to connect those losses back to Enron itself. Many of these SPEs existed only on paper, making them invisible to analysts and reporters. Talk about creative accounting. In an interview, Jeff Skilling famously referred to the financial numbers as black box figures, emphasizing how complicated and opaque they were. This lack of transparency made it challenging for analysts to grasp the true financial state of the company, allowing Enron to maintain its facade for much longer than it should have. As they painted a picture of growth and profitability, they assured the public and investors that everything was above board. However, the party couldn't last forever. The inherent volatility of MTM accounting meant that as market conditions shifted, so too did Enron's reported values. While historical cost accounting is generally more stable and simpler, it doesn't reflect current market realities, leaving companies that relied on MTM to navigate a treacherous landscape. Enron's management frequently tweaked their assumptions about future earnings to keep the illusion alive, often operating on overly optimistic expectations of cash flow and earnings. When the truth finally began to surface, it was catastrophic. Lessons from a corporate catastrophe. The Enron scandal was like a real-life corporate drama, with twists and turns that would leave any movie script in the dust. After the dust settled from this infamous collapse, the term Enronomics emerged, referring to those creative and often shady accounting techniques that became a hallmark of the scandal. Think of it as a high-stakes game of financial hide-and-seek. Enron, the parent company, made it look like it was thriving by using clever, paper-only transactions with its subsidiaries. These subsidiaries, amusingly named after Star Wars characters, were designed to help hide losses from other business activities. Enron would transfer its debt to these special-purpose entities while still recognizing revenue from them. It's like pretending to be financially healthy while your savings account is running empty. As you can imagine, this practice didn't just fool investors. It sent shockwaves through the business world. When the truth came out, the fallout was immense, and it coined a new term, Enron. If you found yourself in the unfortunate position of being negatively affected by senior management's poor decisions, you'd say you'd been Enroned. This could happen to anyone: employees losing jobs when companies shuttered, shareholders watching their investments vanish, or suppliers left in the lurch.
Our 401k, our retirement. Now they tell us we have no job. I mean, Merry Christmas.
Just like that, lives were upended because of decisions made in high-rise offices, far removed from the reality of everyday workers. The Enron debacle didn't just fade away. It sparked a wave of changes aimed at preventing future catastrophes. Lawmakers rolled up their sleeves and got to work, leading to the creation of the Sarbanes-Oxley Act in 2002. This act aimed to enhance corporate transparency and put a spotlight on financial manipulation, making it clear that bending the rules would have serious consequences. It was about time. Additionally, the Financial Accounting Standards Board stepped in to tighten the rules surrounding accounting practices. The goal was to put a stop to the kind of creative accounting that could lead to disastrous consequences. Corporate boards also found themselves in the spotlight as they were given the responsibility to act as management watchdogs. It was a shift that emphasized accountability at all levels of a company. In the end, the Enron scandal didn't just teach us about the dangers of financial deceit. It also led to a greater awareness of corporate responsibility. It served as a wake-up call, reminding everyone that honesty and transparency in business aren't just good practices. They're essential for protecting everyone involved. If you enjoyed the video, don't forget to join us for the next episode. Thanks for watching, and see you next time.